Please welcome Lloyd's Regional Director and President, Americas, Hank Watkins.
Thank you very much, Bob. It's great being here with all of you today, back in my home state. Go Bears! Been back in New York for about 25 years, but started my career out here at Chubb in San Francisco and had a great run with J&H in Los Angeles, and just really good to be back here. I won't complain about the cold because we closed our Chicago office last week when it was -10, but when 0 was on your car thermometer at 6 in the morning anywhere, that's painful. So great to be here. I want to thank the SLA board and Ben, Clifton, Joy, Bob, Deb, wherever you are. You've been great to invite me here. Really appreciate the time I'm going to spend with you. Enya E. is here. She's somewhere in the audience. She's from Dallas. She's my colleague, and hopefully if you haven't met her yet, you will later on today. And I want to say hi to Tony Joseph, our good friend of many years in the Lloyd's market and with Lloyd's America. Glad to be here with all of you. And a thank you to everyone here who is a broker, a cover holder, a cedent. I imagine most of you in the room do some sort of business with Lloyd's, or if you don't, there might be a way we can help you to get there. We've been in business 330 years, as most of you know, more than 125 here in California. Going back to 1906 when we first cut our teeth on a major claim event. There's an urban legend I like to talk about, I think it's true, where the people who were responsible for paying claims out of London said to the San Francisco adjusters, pay out claims irrespective of their validity. Now, we wouldn't do that these days, but I think it did Lloyd's well to start off in the California marketplace that way. So I've got one thing, this is a suit and tie gig. Where is that guy? I love that line. For me, it's a suit and tie gig. I'd rather have the shirt off, but I'll maybe some other time. But I'm going to spend some time talking about our City Risk Index, which is a really interesting report that we put out every couple of years. It's done with Cambridge University. Touches on a lot of the man-made and natural threats that face the world. I'm also going to give you a brief update on our performance gap initiative we undertook last year in London to try and bring the market back to profitability. Talk a little bit about our modernization effort, and probably wrap up with a quick update on cannabis. So we did this study most recently last year, and we looked at the GDP risk only, not the life, health, safety in any cities, but only GDP risk impact in 279 cities across 22 threats, both man-made and natural. And this is all available on Lloyds.com. There's a tremendous amount of data behind this you can drill down into. And if you have questions that aren't answered there, we can certainly get you the answers. But again, 22 threats across 5 categories. 59% are man-made. If you go back 20 years in our careers, it was probably the opposite. A lot of the threats that impacted GDP and our own safety were natural catastrophes. If you look at what's happened with cyber in particular, market crash, and we all were affected by that about 10 years ago, a number of these major events that impact GDP weren't challenges not that long ago. Of these 22 threats, market crash is by far, on a global basis for these cities I talked about, the largest. It's about $103 billion potential impact. You might be asking, as I'm going through these, I'm just going to talk about a couple in each slide, but you can look at all 22 on the website. It's a great opportunity for all of us in this risk solutions business to figure out ways we can help our clients. You might think that there's no insurance available for market crash, but when you look at trade credit, that's been around for decades, and that essentially protects sellers of goods and services against the threat of their customers being unable to pay an invoice or going out of business and paying no invoices. And the market crash event we had 10 years ago certainly put a lot of companies out of business. Trade credit paid a lot of claims and became a much more popular coverage than it's ever been. So there are a lot of ways through risk transfer. And of course, mitigation is critical, but risk transfer is available for most of these threats. Interstate conflict is another one. I'll talk about that in a second. Cyber attack is number 7 on this list. And again, you might think, well, this is a major threat to the U.S. economy, and it is, but again, it's a global study. We looked at 279 cities globally, only 28 in the U.S. So from a global perspective, cyber is perhaps not in the top 6 or so, top 7. It's still critical for us, but much more so in the U.S. Global results, the left bar there looks at the total GDP of these cities we looked at. It's about $35 trillion. U.S. economy is about $19 trillion. The GDP at risk from all 22 threats for these 279 cities is about $546 billion. And that's about 1.5% of the global GDP. Now, on the right-hand side, we've got, again, that list in a layered format, if you can take a look at that. But more importantly, the top 10 cities at risk on the left there shows Tokyo is number one, $24 billion at risk annually. Interstate conflict. You might be thinking, well, no, earthquake, windstorm have a much greater impact on their GDP. But if you look at when this study was done, it was completed last June, there were missiles flying over Tokyo every other week, it seemed. And so to that country and to all the economists who study these types of things, their biggest fear was a nuclear weapon, of course, hitting Tokyo. So hopefully, if things have improved the way we hear they have, it would revert to earthquake as their major threat. But maybe in the next iteration of the study, they'll show that. New York, $14.8 billion at risk annually. The largest threat is market crash. No surprise there. Although Sandy, which hit us in 2012, was probably a close second from a flooding perspective. You go all the way down the list there. We've got a windstorm in Asia-Pac, interstate conflict in Istanbul. Right here in Los Angeles, you're the 7th largest city in the world for GDP risk, and that's earthquake. The second peril for you is a market crash. I think flood is number 3. And then cyber number 4, and all the way down the list. So again, that's all in the report on the website if you want to look very specifically at how LA is impacted. San Francisco, conversely, has earthquake is the number 1 threat. Flood, I think, is number 2. Cyber is number 3. So they're very, very close for these 2 cities. And you look across the U.S., again, 28 cities we looked at, $87 billion at risk for GDP. Didn't look at all cities, but it's kind of interesting to go around and talk about this, because when you pull up a certain city, you can talk about it to the people in the room who are from that part of the world, and it tends to surprise a lot of people what's really at risk in their specific cities. Everyone seems to, you take your personal safety and your family's personal safety as the highest priority, and you get asked a lot, well, why isn't terrorism way up there? And again, looking at it from a GDP impact, terrorist incidents rarely have a major impact on any city. They're isolated, they're tragic, but they don't affect GDP and our ability to continue our economies as much as some of the others do. Quick comment on GDP. We had the government shut down for 3 weeks there. That total impact was about $11 billion, and that was a Congressional Budget Office, a bipartisan organization that estimated that. They said about $3 billion won't come back. So that's a pretty significant number, a man-made threat, if you will. Hopefully we'll never have to talk about that in our report, but it's just one of those instances of how man-made threats can create a lot of issues for us. If you look at the top 10 cities, total GDP at risk, New York is number 1, LA number 2. I mentioned the key threats there. Chicago, all the way down to Seattle. Houston is in there at number 4, and for them, clearly flood is the biggest threat they have. We all saw that through Hurricane Harvey. The main point of this study is, again, we would say this because we're in the risk solutions business, is to help governments, individuals find a way to close that protection gap that we're all facing around the world. We all talk about it after a major event, whether it's flood or earthquake, pick your event. Half the people or fewer that should have had insurance actually have it. You look at China, where they have some pretty significant earthquake activity. There was a big one in Sichuan back in 2008, caused over $300 billion in damage to property alone, and only about 2% was insured. The rest, the government came in and rebuilt, what have you. So that's not a real efficient way, I don't think, to go forward as a global society. Wouldn't you rather have governments invest in healthcare, education, infrastructure, and let the risk experts, who we are and our thousands of colleagues across the world are, who understand these things, provide ways of transferring that risk to us. So if we can, through this study and other things we're doing, just get governments in particular to think about encouraging their constituents to take more personal responsibility for their own risks as well as their businesses, I think we'll be in a much better place. And we'll never be completely risk-free, that's pretty obvious, but we as an industry together can take this a long way. Quick comments on emerging risks. We all know that it's something that we're familiar with, but we're not real sure yet how it impacts our industry. That's, of course, why we're here in the E&S sector, is to look around the corner constantly, figure out ways to help our clients get smarter about how they
improve their businesses and go forward. We do a study every couple of years of the managing agents in London. There are about 53 managing agents, and there are a few of you in the room here whose companies own managing agents that actually run these syndicates. And we talked to the CEOs and the active underwriters about what's keeping them up at night. Now, this one was done back in 2017, so you see cyber there to them, of course, because we're writing so much cyber globally, over $1 billion in premium. It's a major concern of theirs. Terrorism, again, because the Lloyd's market's a big provider of terrorism coverage, but Eurozone instability, this was right around the time of Brexit. I would suggest that perhaps that is now number one, not number three, because to this morning, there's still no definitive answer out of the government as to what they're going to do. Fortunately, our industry has done a terrific job of basically managing that risk. I think most insurance companies with major UK operations have set up companies across Europe. 5 or 6 major cities have become the homes. I think it's Chubb in Paris, a number of them in Frankfurt, Dublin. Lloyd's set up an operation in Brussels last year, set up an insurance company. We didn't re-domicile, so don't take this away that we've re-domiciled. We haven't. We're still London-based. But we have an operation now, Lloyd's Insurance Company of Europe, in Brussels that's going to allow us to do all that business in an EU country and then reinsure 100% back to London. So no impact there for us personally. And I give a lot of credit to our former CEO, Inga Beale, because the minute this vote happened, she got out there and started getting this going because she didn't want to rely on the government to take care of the people. So we're through that. Anything you want to talk about Brexit, I'm happy to do that later. I don't think any of you want to hear me ramble on about it right now. Emerging risk reports. We publish a lot of these every year. And Swiss Re, Munich Re, they have terrific thought leadership materials too. But if you go to our website and just lloyds.com/emerging risks, you can download all these in a PDF. And it's really interesting how they allow us to talk to people and somehow make insurance cool. I don't know if it's ever going to be sexy, but you can have a conversation about a lot of neat things by reading these reports. The middle one on the top there is about the sharing economy. We've got a consortium there called IBOT. It's led by Apollo Syndicate. It means Insuring Businesses of Tomorrow Today. And they're the leader in all the sharing economy business that is percolating out of the San Francisco Bay Area as well as across the country. And what they're selling is trust. It's not just insurance, but they're convincing these sharing economy companies, any one of them, the home sharing, the ride sharing, that they need to develop trust in the users as well as those who are allowing their cars and homes to be rented to strangers. And the only way to do that is through the transfer of that risk to insurance. And it's really a unique psychological play here that Apollo and the IBOT folks have done really well at. We've got a couple of cyber reports that have come out recently, most recently just last week. So if you want to really be scared, read that. Again, the focus of this one is on ransomware. We've all heard about these attacks over the past couple of years. Really interesting. Lower right there is California flood. Tony, you were with us when we had this conversation a couple of years ago. We did a pretty interesting study on California and how the Central Valley, if that ever flooded, would have a major impact, not just on the state, but on the whole country. And then we got it all ready to be published and issued, and we thought, wow, it's August. There's been a drought for 10 years. Who's going to even think we have anything to say about flood? And so we kicked it around. We did issue it, I think, in September, and got a little pushback on, why would you even think that California has a flood issue? Do you even live here or come here? But last couple of years, you've seen how floods have impacted the whole state. And again, if you get a combination of a typical rainy winter and a Pineapple Express, there could be a lot of issues here. So interesting reading. We've got another one on business blackout, looking at how a cyber attack could impact the northeast corridor of the U.S. So there's a lot in there to read and be comfortable with, because this is the business we're in, finding the interesting things that are super scary and that do have solutions somewhere. They're not all at Lloyd's. They're within our E&S sector. And if they aren't there, then it's up to us to find ways to create them. So that's the underwriting room at Lloyd's. The 4th floor now has a Lloyd's lab we're really proud of. And it's we basically accept applications from technology-driven companies around the world that want to come into our marketplace, they incubate for 10 weeks, They have mentorship through the Lloyd's market, and if we get one or two that come out of the other end of that with an investment by a Lloyd's syndicate or another provider of capital over there, we think it will be a success. But the whole point is you've got plug and play out here, and this is sort of Lloyd's plug and play equivalent, if you will, in the London market. And what better place to do it? I mentioned briefly we have a new CEO, John Neal. He joined us from QBE back in October, and he's just passed his first 100 days. It's refreshing to have him there because he's looking at the entire world and how we do business. You know, he's come in at a time when Lloyd's has just come off one of their worst years ever. 2017 was a particularly bad year for Lloyd's. We finished at a 114% combined, and that was a global number. Hurricanes, earthquakes, wildfires, just in Mexico and the US, then you expand across the world, a lot was going on. But if you take out the cat losses during 2017 and you only look at the attritional losses, we were still at 105. And that's an impossible number to justify and stay going forward on. So last year, in the middle of the year, as the business planning process started at Lloyd's, and for those of you who aren't familiar with that, the 89 or so syndicates that write business on our platform every year have to present a business plan to our colleagues in London. They go through it with a fine-tooth comb for several months, and if they agree, and if my colleagues agree that the underwriter has the experience, the capital, the claims people on the ground, et cetera, to do this business profitably, then they get a go-forward stamp. If they don't, then they have another conversation. So we had all syndicates last year come to us and bring their worst performing classes to us, and of those worst performing classes, the bottom 10%. And it was a really painful process for everybody involved. Those of you who had binders that were hanging out there, apologies, but hopefully by now you've gotten what you need, or you're close to getting what you need from your managing agents over there, your underwriters. But at the end of the day, Lloyd's will be a smaller market in 2019, but I gotta say, the growth is not always the answer to success. You know, you can't improve your expense ratio or your loss experience by growing the top line. And so I think we've taken a pretty bold step, and we're off to the races. We have plenty of capital, more capital than ever. So all the gloom and doom stories you may have heard about Lloyd's, you know, we're here to explain to you why that's not the case. And brings me to another topic, modernization. Traditionally, Lloyd's has been a pretty cool place to visit, but as we get more and more younger people through that room on tours, they come away a little bit bemused by all the paper, people hauling stuff around under their arms, you know, to place a risk. And it's, okay, it's interesting. That whole picture, if you will not be there in a few more years, because we're pushing really hard to modernize the market, have all the trading done electronically, and we're getting really close. We had to mandate it. You know, it's called the Placement Platform Limited, and it requires submissions by email, binding by electronic digital means, essentially getting rid of all the paper. And it allows us to process all the millions of data points that we have every year much more efficiently. We're not there yet, but we are getting there, and that's going to be a big boon for Lloyd's, and it will get us off that 40% expense ratio that we have. I don't know how anybody can continue with 40%. That's just an unsustainable number, and through technology, we think we're going to get that down a fair amount. So that's pretty exciting. Anybody who wants to talk about GDPR, we can do that. There have been some cover holders in the U.S. who've been asked by their managing agents to show how they're GDPR compliant, which is fine if you have business in the EU. If you don't, you aren't required to be GDPR compliant. So any issues in the room with that, please see me or Enya, or call us later. We'll be happy to talk you through that. And finally, I'm getting close here, it brings me to cannabis. So Lloyd's was in the business in a big way in California and then throughout the U.S. for a number of years. In May 2015, we got out of it because of the federal government prohibition. I don't disagree with that stance, but it made a number of folks upset with us, but I think the domestic market filled in those gaps, not all of them, but most of them pretty quickly. Since the Farm Bill was signed back in December, taking hemp extract off the federal list, the DEA Schedule I list, Lloyd's has opened up their arms, if you will, to the U.S. market to write hemp extract products. I mean, I guess we figured too, if you can buy CBD oil on Walmart.com, you know, we're missing a trick here. So anything with THC content in it, we're not going to touch. Although, if you go to Canada and want to start that business, we're all in it because the federal government says bring it on. So I don't know where to go with that, but our stance has changed a bit, just so you know on that. And on that note, I guess I just want to thank you for having us up here. We pretty much are in the U.S., Canada, and Latin America on behalf of the Lloyd's market. We do all the regulatory affairs work, business development, if they'd like us to, handle questions with cover holders, both existing and new, get involved in claims sometimes when they're particularly tricky, but I'm not advocating that you call us on that. What we don't do is underwrite or 20 minutes, Clifton. Stop. See? I'm getting better. It was 22 minutes in San Francisco. So anyway, we're here to help you. So any questions you might have, feel free to call us. We have 12 offices in the Americas, 6 here in the U.S., and Enya never sleeps, so feel free to call her any time of day or night, and she'll be happy to help you, as will I. Thanks again, everybody. See you on there.